Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go. Welcome again, everyone, to another edition of the Retirement Roadmap podcast, brought to you by SHP Financial, and I'm your host today, Matthew Peck. I certainly want to wish everyone a very happy new year. And in this time of year, we often talk about New Year's resolutions. And for geeks like me and for usually our audience, we talk in terms of market outlook. What's going to happen this year? What will tariffs do? And what will the Federal Reserve do? And what's going to happen with AI? And all of those questions. And we couldn't think of a better guest to bring on, and a more special guest, in our opinion, than Mike Arone. He's the Managing Director and Chief Investment Strategist for State Street Investment Management. He's been in the industry for more than 31 years. So if anyone has that amount of age in this business, then he must be a sightseer. He must be able to read the tea leaves and tell us exactly what's going to happen, right? So we'll put Mike a little bit under the microscope here, all joking aside. But Mike, thank you so much for joining the podcast. We're more than honored to have you on the show.
I'm very excited to be here, Matthew. It's going to be a lot of fun.
Yeah, I mean, and obviously I was joking, tongue in cheek. All the compliance directors. Mike is not going to guarantee what happens in the future. We all know he can't predict the future. However, it's there are trends, and there are topical things, again, like I mentioned, AI, the Fed, and certainly things that we'll get into, and we'll be very interested to see your own individual thoughts, and then just the collective thoughts of State Street in general. But before we go to the future, let's talk a little bit about the past. I mean, how did you climb the ladder? I mean, how did you get to where you are right now? And I have no problem starting from the beginning, because it's an amazingly accomplished career of 31 years. And so how did it all start? And did you see yourself where you are today, even 31 years ago?
I'm flattered by that in terms of this accomplished career. So we'll see. I'll let all of you be the judge of that. For me, interestingly enough, and somewhat comically, I think I saw the movie Wall Street by Oliver Stone as a teenager.
Right.
And I think it was a cautionary tale, but I was like, wow, this is really cool. And so that's kind of interesting. And that sparked my curiosity. And I went to Bentley College. It's now Bentley University. I was a finance major. And I just always had this incredible curiosity about markets. And I remember when I broke into the business way back when, smiling and dialing, trying to build my own kind of book of business from a financial wealth perspective or a financial advisor viewpoint. And the gentleman who was my mentor at the time said, Mike, every night on the news, every day in the newspaper, the stuff that goes on impacts the economy, rates, inflation, the companies that we're looking at, et cetera. I thought, wow, that's incredible. Well, it's daunting, it's overwhelming, but boy, I want to be at the heart of that. So that really sparked my enthusiasm, my curiosity for this industry. And really what's interesting too, Matthew, is in the last 30 years, 28 of them have been spent at State Street Investment Management. So I think that's a little unusual. And I often say, so folks will say, well, Mike, like, why would you stay so long? Like, nobody does that anymore, right? Or very few people. And so when I look at this career has provided me a few things. And when they do studies about why people stay with their firms, it doesn't matter about financial services or anything like that. They look at three things. They look at, is the work interesting? Is it challenging? Does it push you intellectually? That's one. The second is, do you have the autonomy to do that work? Are you given nobody likes to be micromanaged. Do you have the leeway to get things done? And then third is certainly, do you feel rewarded? Of course, compensation is a part of that, but recognition, praise, promotion is also part of that. I've always had those three things at State Street. I took my family to London in the middle of the global financial crisis because they gave me an opportunity. And boy, it was uncomfortable and it was fascinating, but I'm grateful that they gave me that opportunity. And I think it made me a better person, both professionally and individually, to have it. And so those are the types of things that I kind of have grabbed onto in my career.
Yeah, well, and I certainly want to talk about '08 because I mean you were there at State Street for some obviously heavy headlines things like '08, but also I'll ask a little bit about the past about the structure of the ETF, or the exchange traded fund, which State Street, I believe, was the first to kind of introduce in the late '90s or early 2000s.
So 1993,
93.
State Street launched SPY, and it was the first U.S. listed ETF. And now today, so Matthew, what's interesting, right, is we spawned that. It came out of the 1987 market crash when portfolio insurance, and we won't get too wonky today, was a thing. And ultimately, it went a little upside down, and investors couldn't get the liquidity. They couldn't get out of the market in the way that they had anticipated. So a number of participants got together, market participants got together to see, could we create a basket of securities with liquidity that could trade throughout the day and ultimately kind of help solve that problem. Now, October 87 was the market crash. It didn't launch until January of 1993. So it took a while to come up with the packaging, to overcome the regulatory kind of obstacles and bring this to market. And now today, Matthew, the ETF industry globally is approaching $20 trillion. And in the US, it's about $13 trillion. So in some ways, State Street Investment Management was at the start. What's the term with how the solar system was created?
Oh, Big Bang.
The Big Bang.
Yeah,
the
absolutely.
Big Bang of the ETF kind of ecosystem.
No, and in my opinion, obviously, nerdy opinion, but like it was absolutely game changing. And just to pause for all of our listeners, a lot of people ask about ETFs and mutual funds, and I sometimes will tell clients that ETFs are like mutual funds 2.0. Where the mutual funds, the idea of a basket of stocks, it literally goes back all the way into the 1920s. I think MFS was the first that put together the mutual funds back in the 1920s. But it was a wonderful idea. So let's diversify. Let's allow people to buy into a basket of stocks, not just one stock, because obviously high risk and high reward, but high risk with one individual stock. So let's create this ability to then buy in to the market and to diversify with $1 or $50 or $100, whatever that may be. And that was able to get, it was a way of democratizing the investment world so people could get involved. So now 80 years or 60 or 70 years goes by. Interestingly enough, you talk about the liquidity. So now this exchange traded fund was created based on liquidity. Question is, one of the other big differences that people talk about mutual funds and ETFs, though, is capital gain distributions. Because we also love ETFs, and for SHP clients, you'll see a lot of ETFs within their portfolios. We also use ETFs not just for the liquidity aspect, to be able to trade daily, which as a portfolio manager we don't do too often, but it's also good to have that liquidity, of course. But also ETFs were really good on capital gain distributions or saving on capital gain distributions. Was that something that was part of, did that drive the conversations at all? Are you aware? Or was it really liquidity is drove the formation of these new product?
I think what's fascinating is at the heart of this, like a lot of things that are discovered, we didn't think about all of the different applications at the beginning. And what's interesting is folks like SHP and others started to kind of think about ways to use ETFs. And so, of course, we wanted to provide that liquidity, that transparency. But then others embraced this notion of tax efficiency and low cost. And all of a sudden, what morphed as a solution to a capital market problem came into the kind of wealth management platform where firms like SHP were thinking about tax consequences, liquidity, transparency, and of course, cost, all incredibly important elements, and diversification. And they thought, boy, these tools are incredibly useful, and we can build portfolios with them and address all of those things simultaneously. And of course, that was the next incredible leg of growth in the ETF industry, is that they kind of became a core portion of many individual portfolios and diversified portfolios because of some of those things.
Well, I think in terms of the 401k industry, I mean, I'm pretty sure like the 401k was like established as some random like IRS rule somewhere there, and then suddenly it's like some sort of HR guys and gals were just realizing like, wait a second, we can use these 401ks as sort of a separate pension program and move the onus off of the company and on into the markets, or sort of privatize the pension system. I mean, there's pros and cons with it, and I won't dabble any further than that. But it's more the idea of sometimes it's like the law of unintended consequences, which then sort of change the world, or at least change the financial industry.
Right. And so you asked me up front, hey, what brought you to this industry? Like, isn't this incredible that we created this thing to solve one problem, and then the capital markets and investors came in and found so many other use cases? To me, as just a curious person, I find that incredibly fascinating, exciting, motivating. And yet today, folks continue to find more and more ways to use ETFs. Now they're using options in ETFs to generate income.
Yes.
We were chatting before, right? Your 5 worlds, your income, your tax, kind of legacy, all the things. I won't get them all right, but kind of estate planning, healthcare. I think I got them all, Matthew.
I think eventually you got there, Mike.
I got there,
yeah,
right?
All right.
It took a minute, but I got there. But ETFs are being used to address a number of those things now: tax, income. And so it's just been an incredible kind of ride to be alongside and watching how capital markets have taken this seemingly simple instrument and found so many different use cases to ultimately kind of help investors reach their financial goals. Well, look, that's kind of, again, you said, hey, what brought you here? Like, why are you in this industry? That's, I think, an incredible achievement for the industry, not only for State Street Investment Management, but for the industry. And it really changed. It was the proverbial game changer for how folks think about investing.
Well, it's so true, and I love that idea of it continually reinvents itself. I mean, it's never standing still, right? And I used to joke around with some of my buddies about how it's like, if you like sports and following sports and all of that stuff and tracking box scores and different things like that, you're gonna love the markets. You're gonna love the following the markets and following all those macro trends, and so. It really, again, it never stands still. It's constantly reinventing itself. And I think in general, it's been moving in a positive direction for the average investor, because now they have ability, and now they have advisors like ourselves, and not to toot our own horn too much, but just the idea of, fiduciary-based investment or advice. You have fee compression, or some of these fees, and the cost of investing has come down. So I think it's bending towards, in general, and I'm curious your opinion, but it really is bending towards better for the individual investor.
Right, it's absolutely, and you can see investors vote with their feet, and so the last 2 years have been record years for ETF industry flows. So more than $1 trillion came in 2024. And what is now approaching $1.4 trillion for 2025. Those are back-to-back record years. So again, investors vote with their feet. They wouldn't be using these vehicles if they didn't experience the benefits of them or feel the benefits of them. And you compare that, again, we're not here to bash mutual funds. They certainly have a place in some portfolios and things, but relative to the tax efficiency, some of the capital gains, some of the costs, things like that, they're actually been a bit more stagnant in terms of their growth, and yet ETFs continue to grow at a much faster rate. And so, again, this is a capitalist market. Folks vote with their feet. They're going to go with what works, and apparently they're finding that the benefits from ETFs are working well for them. Back-to-back record years, and the adoption rates continue at a high level.
Oh, I love that stuff. So, okay, so now there are obviously darker moments in financial engineering, if you will. So, if you don't mind, we'll end on a positive note, of course. All right, but what? So you were there in 2008. I mean, what was your role in 2008, 2007, 2008, and I guess just how was that experience in general? And was there any inclination it was coming? And well, again, you mentioned London, so it sounds like there was also some personal change that was happening at that point. But Share what it was like in '08.
Yeah. So I had been working with State Street for about a dozen years. I was kind of working as part of an active quantitative equity team for a while. And I had the opportunity, there was a team of investment strategists in Europe, and they had been managed globally, and they decided to manage them more regionally. And so they asked me, would you go and manage our European team, our EMEA, Europe, Middle East, and Africa team, to go over to London and manage that team. And so I leapt at the chance. This was back in 2008.
Okay.
Things had started to.
So this was like spring 2008,
yeah,
or was this
before school? So I remember going over in the summer in London,
Okay.
checking out schools
Okay.
and places to live. So the cracks had started to form, but the Big Bang, I guess, to
Yeah.
continue our metaphor here, hadn't happened yet.
Yeah, we'll keep on using the universe.
Right.
Absolutely.
So
I like it.
we got to London. My wife and I had my children were 7 and 5, and we got to London in August of 2008. And we were in State Street Investment Management's building, was in Canary Wharf in London, for those that are familiar, in the Lehman Brothers building. And of course, in September, Lehman Brothers went bankrupt, went out of business. And the black cabs were all up front, the TV cameras, people in the elevators on the phone saying, yeah, I have 3 months. If they weren't UK citizens, I have 28 days to leave the country, and things like that. And our stuff was being shipped over from the US. Typically, it's on a boat. And so I said to my wife, you may not want to unpack. I'm not sure how this is, how this
how's
will
it going to
shake
play
out.
out, right?
Well, good news is that, so I was managing this team of investment strategists across asset classes, cash and equities and bonds and alternatives and commodities and multi-asset class strategies, spread all through Europe, Germany and France and the UK and Brussels. And so I went over to manage that team, and I was there for 3 years. And so we made it through, like everybody.
Yes.
We made it through to the other side. But it was interesting. And so one of the lessons that I kind of learned from that experience, at least as it relates to investments, is that, when we studied school year CFA, I'm a CFA, and things like that, we kind of have this vision that everything fits in this normal distribution where kind of things cluster around the average, and those fat tails, those kind of crazy risks rarely happen. I think what I've learned in my 30 plus years in this business is that the 100-year storm happens far more frequently than 100 years.
Right.
And I think 2008 was an example of that. Of course, the pandemic was an unusual period. For us both, the TMT bubble bursting back in 2000, which wasn't all that long ago. So the 100-year storm happens far more than the statistics would suggest. So this tells me that markets are not normally distributed and cluster around an average, and that there's fat tails. On average, most of the time, we're positively driven, which is why when we build portfolios, we tend to allocate a fair amount to stocks and to risk assets. But every once in a while, things go wrong. And I think, again, having those diversifiers, having SHP or others help manage those periods of time is critically important to financial success.
And so, but if you were, obviously you weren't at Lehman or you weren't at AIG, who was underwriting some of
Thank
these.
goodness.
Yeah, right. There's these CLOs or collateralized loan obligations and whatnot. I mean, when you talk about the cracks, I mean, were the cracks visible in your experience? Were they visible to you, or were you just kind of hearing about them, saying like, okay, this is interesting, this is a little concerning? I guess. I'm curious about that moment in time, and I hope it's because you're right, absolutely true about diversification and true, time tried, traditional investments and diversifying for times like that. Because to your point, times like that are going to happen again. It's just that's why they call black swan events. I got a great question from a client like, I know we talk about black swan events. Do you see one coming? And it's like, by definition, my friend, it's a black swan event. You don't see it coming. But I'm just curious whether or not there was any inclination in your world at that time that we were about to fall off a cliff.
I think earlier in that year, Bear Stearns went under. There was kind of growing pressure for some of the mortgage companies. Remember Countrywide, for example. So there were cracks and signals that were starting to form that perhaps something was amiss. But I do think that oftentimes, I kind of looking in the rearview mirror.
Right, because hindsight,
hindsight's 2020,
Right.
right? And so I definitely think there were things that in hindsight, you're like, okay, yeah, this is, was problematic. And there were signs, as you said, as early as 2006, there were signs. 2007, Bear Stearns certainly went out in 2008. And so folks had fair warning. And ultimately, the Lehman event in September of 2008 was kind of the cataclysmic event of that time. But as early as 2006, things were starting to shift.
Starting to look at because I think sometimes and I'm almost like asking you because of the questions that I get from investors or from clients of SHP is not necessarily '08 again, but and I think but more so like, hey, whether it's recessions or whether it's a big dip or a big bear market. I mean, you sort of saw. I mean, obviously 2020 was a completely black swan event. 2022, you kind of knew was coming because you just the impact on the Federal Reserve and jacking up interest rates that fast is going to cause some disruption in market valuations. But I go back to '08 only because myself I was in the field, but I was only in the insurance field at that time, so I saw it play out, but I was not as tuned into the equity markets as much as I am today. And again, I'm trying to like, okay, I want to make sure that I'm looking for that canary in the coal mine. Not that we would ever go, okay, hey, everyone, we're going right to cash. We're going to pull out because we're going to overact. I mean, we never really overact in that way. But I'm always trying to say, okay, learn from history. You know what I mean? Learn, and not that the past performance is no guarantee, and history doesn't repeat itself, but it does rhyme. Okay, let me see if I can find those canary in the coal mines. And and so I'll go to these conferences and I'll say, there'll be speakers and you speak too. And I'm just, by the way, he speaks in front of a lot of people in a lot of industries, but I'm always trying to find, contrarian voices and maybe not perma bears because perma bears are always negative, but more so that okay, if I go to this, industry, it's usually always positive, because that's our world. We're optimistic. We wouldn't be investing in equities if we didn't think that over the long term we'd be fine. And I guess it's that old line of, don't ask your barber if you need a haircut. Yeah. He's going to say yes. Or and don't ask an investor if the markets are going to go up because generally they'll say yes.
Right.
But I mean, so that's a long-winded way of saying that, are there any canaries in the coal mine that you or anyone either from that experience in '08 or going forward really pay attention to say, okay, this could be something to monitor?
So let's take a very practical example from today. I bet your clients are asking you possibly around AI.
Oh, yes.
And is AI in a bubble, right?
So you skipped ahead to a couple of my questions here, but that's all right. Go ahead. All right,
let's tackle it now. Like you said, this isn't. We're not going to have all day, so we'll get to it, right? So AI, I'm sure folks are asking AI in a bubble. Certainly towards the end of 2025, particularly in the kind of November timeframe, that was a big question. And so there are certainly some things that were indicative of bubble-like conditions. So some of those things. So we had a general purpose technology, AI, that's being adopted, and there's incredible capital expenditures. Folks are spending a lot of money to try to figure out how to monetize it. So
just to pause, I never heard the term hyperscaler before, but now I know all about hyperscalers.
Now you know all about it.
Yeah,
so general purpose technology, a lot of capital investment from that perspective. We also have had a massive transformation in the way capital is allocated. So we're talking a lot about history. But here's the thing, if you think about it, in 1996, Matthew, there were more than 8,000 publicly listed U.S. companies. Today, that number is closer to 4,000. Over that same period, back 2 decades ago, there were only about 1,900 U.S. companies working with a private equity partner. Today, there's more than 13,000. So and we also think about the private credit market. It's quadrupled in the last decade. So the way that capital is now allocated has transformed considerably. You also have a great deal of credit creation, which again isn't a good or bad thing, but these are not symptoms, but bubble-like things that folks should be keeping an eye on. You have a deregulatory environment that's likely coming, and you have a Federal Reserve that is lowering interest rates or being more accommodative. I look at those things, and that is fuel for risk assets. And of course, we've coming off of 3 consecutive very good years. And I know we'll get into this. I think next year might be another decent year for risk taking. And so those kind of conditions are there. Now, let me give you 4 reasons why I don't think AI is in a bubble. So there's the reasons you're saying, hey, what should I look for in terms of what are some of the telltale signs? So general purpose technology, massive capital investment, transformation in the way capital is allocated, credit creation, deregulation in the Fed. So there's your list. Why is this time not that? 4 things really quickly. So you'll remember back in the TMT bubble days, growth companies' earnings were actually contracting. Today, they're expanding. So what's interesting is technology earnings are growing at an incredibly fast rate. So that's one thing. The second is that the duration and the magnitude of the capital expenditure cycle back in the 90s was much longer and much bigger than today.
So I'm sorry, explain that last part if you don't mind.
Absolutely. So meaning in the 90s, more money was spent on fiber optic cable and all that stuff than what has been spent on AI.
Oh, in comparison, so
right.
when they were laying the rails, because they talk in terms of booms and busts and general purpose technology, they'll compare 2000s. They'll also go all the way back to the railroads and say, okay, how much was spent. So they talk about laying the rails, right? So they laid the actual rails in the 1880s. We're talking. And then in the 90s, they laid the rails in the fiber optic space. So if I understand you correctly, the rails or the expenditures in the 90s is actually less.
More.
I'm sorry. Is more in relation.
Longer. Occurred over a longer period of time and was much bigger. So my point here is that the AI spending is only just beginning. We're in the early stages. So that's 2. The third one is around profitability. You'll remember back in the TMT days, the companies that performed the best had the highest multiples, didn't earn any money. There was no earnings to be had. It was clicks and eyeballs. Today, investors are hyper-focused on profitability. So just recently in the earnings season, when Meta announced a greater kind of capital expenditures and Oracle decided they were going to go to the debt markets, investors weren't clear on what the path to profitability was for those investments. And those stocks got punished. Matthew, what will be fascinating for people to know is in 2025, technology companies didn't experience multiple expansion, meaning investors didn't pay a higher price for technology companies' earnings. Their returns have all been driven by earnings growth, not multiple expansion. So that's important. And then finally, when you're asking about what is that pinprick for the bubble, historically, it's been the Fed raising rates. So we talked a lot about history so far today. In 88, 89, the Fed was raising rates. It ultimately led to the savings and loan crisis and the 1990 recession. In 1999 and 2000, the Fed was raising rates at the time from 4.75% to 6.5%. And in March of 2000, the TMT bubble burst. And then we've been chatting a lot about the global financial crisis, kind of the more recent one, except maybe the exception of the pandemic, which again was such unusual, right?
Right, anomalous.
So in that one, the Fed was raising rates from 2004 to 2006. So you asked me about, hey, were there some signs? Like what could you look for? Historically, the Fed tightening monetary policy is the pinprick that bursts the bubble.
Yeah.
As we start 2026, the Fed is cutting rates and they have stopped quantitative tightening. They've been more accommodative. So for those 4 reasons, I don't think we're in a bubble environment. I think some of the conditions are there, and this may inflate for a while longer.
Yeah.
But for me, what I would be looking for is Fed tightening monetary policy or an unexpected acceleration in interest rates, similar to what you highlighted in 2022. That will be the mechanism that potentially hurts what has been a strong bull market rally since October of 2022.
But then, all right, so now let's talk about the Fed. I mean, I'm not sure your / State Street's outlook for this year. I know, again, we're early in 2026 as we speak. I mean, I guess just inflation numbers. I mean, in personally speaking, obviously I'm very concerned not just about inflation, but just obviously government debt levels, which we can set aside for now. But I think in general, overall outlook for 2026 in regards to what the Fed is going to do and just the impact on inflation.
So I think the Fed will be accommodative in 2026. They've certainly cut rates a number of times here at the end of the year, at the end of 2025. They've also stopped quantitative tightening, meaning the reduction of their balance sheet. So that'll have some stimulative effect. That's actually worth about 0.25% rate cut. It's kind of equivalent, if you will. So they've been more accommodative. Now, here's the thing that I think is interesting from a few standpoints. So I'll give you a few points. So first, the Fed raised rates, as you mentioned, in 2022 to around 5.25%. They've reduced rates by about 1.5% or so over their rate cutting cycle. That's about a 29% retracement.
Okay.
So other central banks, like the Bank of England and the Bank of Australia, have been cautious also because of inflation,
Right.
what you mentioned.
Right.
But many other central banks, like the European Central Bank, the Bank of Switzerland, the Bank of New Zealand, and the Bank of Canada, have actually cut rates greater than 50%, retraced their rate hikes from a higher. So the point is the Fed has some wiggle room here, in my opinion. They've only cut back about, let's call it a third, if we don't want to be too precise.
Yeah.
They have more room to cut from that standpoint.
Well, and I think too, just to jump a little bit back to 2025, I mean, what did you / State Street? I'm kind of using you guys separately because I know obviously there's other thought processes and people and thought leaders there, but what was the impact on? What type of trickle down impact did you actually see on tariffs when it came to inflation? Because I have some people that say, nope, it's a one-off, or I've heard this great line of like, it's not really stagflation, it's more like inflation stag, in the sense that inflation comes first and then stagnation comes second. Others say, okay, it's just a one, little bump that happens initially, and then life moves on. I mean, what evidence did you guys actually see in 2025, if at any?
So I've been in the camp that the fears about tariffs' impact on inflation have been largely exaggerated.
Mm-hmm.
And again, not to say that there's no impact, and there's certainly specific items that are impacted.
Right.
But overall, when we look at and take a step back and look at the broader economy, the impact to inflation hasn't been all that meaningful. And so I'm of the camp back in 2018, when we were in the first trade war, if we want to use that terminology with China, tariffs weren't inflationary. And I didn't expect them to be this time as well. And so you can't describe tariffs as a tax and then tell me that they're inflationary, because we know that taxes are regressionary and they reduce consumption. So what's really interesting, Matthew, is the Fed just released a paper. The San Francisco Fed just released a paper to suggest that tariffs are actually deflationary and not inflationary. Now, some would argue that the timing of this, for those conspiracy theorists, is so that they can give themselves some air cover to continue to cut rates. But it was interesting. The Wall Street Journal picked it up, and the journalist there, always covering the Fed, he picked it up. And the San Francisco Fed, at the end of 2025, issued a paper suggesting that tariffs are deflationary because they reduce consumption. And sure enough, the economy seems to be cooling a little bit, perhaps, in some areas as a result of that.
Well, and I just sort of saw it as supply and demand, in the sense that, okay, if we're moving that XY chart down a little bit, meaning that, like, okay, hey, tariffs, cause costs. Let's argue for a moment that tariffs will cause costs to go up. Well, then that demand for that product will then come down a little bit, and then it will find its equilibrium, at that stage. So, that was because, as you said about the overstated and sometimes the I will not get into I guess I'm part of the media because I'm on the podcast right now, right? But we all know we live in this world of 24-hour news and clickbait and heavy headlines, and it's just sometimes, and that's why I appreciate obviously you coming on. And then I will get on my soapbox now, but just provide get the wheat through the chaff, finding out what the actual information is, what the actual data is telling you, and things along those lines. Because to jump, kind of back to the Fed and what they're going to do about cutting rates and easing and whatnot, because I also saw that similar supply and demand impact on jobs, in the sense that, okay, hey, we're cutting off the supply, on the southern border, a lot of the immigration and the HB1 visas and different things like that. And okay, well, that will then have an impact on demand. So it wouldn't necessarily, it's almost like we'll have a similar effect that it won't necessarily push up wages too much, because it's that same laws of supply and demand going on. Am I on the right track or not really?
You're on the right track. And so if we look at this, right, the Fed has this dual mandate. Some argue they might have different, a third mandate, things like that. But if we stick with the dual mandate and we look at the full employment part of it, the Fed made a purposeful pivot back in August to focus on the downside risks of the labor market. And so to your point, they described at that time, and we're still in this scenario, that the labor market is in a curious kind of balance. So what you're describing is unfolding. What's happening is that both the supply of labor and the demand for it are falling simultaneously. This is unusual. Why is this happening? Three things: tougher immigration policy, which you highlighted, demographics is another, and AI is the third. So what's really interesting, Matthew, is that the U.S. may not need as many new jobs as they have historically to keep the unemployment rate reasonable. It has been ticking up lately, but the risks are definitely skewed to the downside. And the Fed took notice back in August and began cutting rates again, which I think was the right move. And so when we look at the ADP data on private employment numbers, kind of for the 4 weeks through early November, actually the jobs declined by about 13,500 per week. The labor market is softening some. The unemployment rates ticked up. Now, let's turn to inflation real quick. So inflation historically, the drivers have been surging oil prices. Of course, that's related to the 70s. I know This is like a history podcast, right? So that's related to the 70s. Oil has been well supplied and prices have been reasonably low, right? Mm-hmm. And the administration's focused on continuing that momentum. Yep. The second thing that typically happens that produces inflation is voluntary separations. People quit their job and jobs are plentiful and they have negotiating power, and it's about a 6 months lead time. That's not happening right now. The job market is softening. And the final one is rents. And again, it's a bit wonky, but it makes up about 30% of most of the broad measures of inflation. And rents, actually, it's not everywhere. So if you're somewhere in a geography saying, hey, my rent is still high, or boy, my children or whoever's paying high rent, absolutely.
Yeah.
But in a broad pockets of rents are falling. So it's really hard to see inflation reaccelerating. And so those are two reasons. Now, I'll give you a third. As we concluded 2025, there's some things that go on with the capital markets. So the reverse repurchase rate, kind of the short-term financing rate, which caused some problems back in 2018 and 2019, and the Fed reacted. The standard overnight financing rate has actually been creeping up and is above the effective funds rate.
Okay.
The Fed also created a facility for COVID to help, a repurchase facility to help with liquidity and things like that. That has now been drained, so that's out. The other thing that's happened is once we reached an agreement on the debt ceiling, Treasury began to rebuild the Treasury general account. All of this takes out bank reserves. So the Fed has moved from abundant bank reserves, about 10% of GDP, to ample reserves. The point of all this, right, if folks are like, I'm getting lost here, right? The point of all this is that monetary policy conditions are actually tightening in the capital markets. And a lot of people who don't have that nuance don't know it.
Yeah.
So not only is the labor market softening, I gave you the reasons why I don't think inflation will reaccelerate. Now you have this capital markets kind of challenges on the side here, which is why they ended quantitative tightening.
Right.
This is why they did it. Because without doing it, it would cause some additional stress.
Too much tightening.
Too much tightening, and perhaps a little bit of a capital market tantrum, which again is what we saw in 2018, 2019, which they had to catch up on. They don't want to do that again. For all of those reasons, I believe the Fed will be accommodative. Not only have they resumed the rate cutting cycle, but they'll likely continue it. And boy, if we want to add another one, Chairman Powell's term ends in May.
Right.
We now have a new Fed chairperson, and they're likely to be a bit more dovish than hawkish at this point.
Yeah, and I'll try to. I wanted to ask whether or not State Street was making any bets on who that will be, but I won't put you on the spot too much there. But I think it's funny when we talk about interest rates too, and cause I think another big issue, and I'm curious how much just your overall opinion on it, because yes, the Fed might be able to raise long-term rates, but short-term rates. Forgive me. Yes, the Fed might be able to lower short-term rates, but the long-term rates might not budge. And then I know a lot of people, because you mentioned rents, and this is kind of what got my mind thinking, is just the impact on housing and getting people into that ladder in single-family homes, and the lack of development and NIMBYism and things like that. I mean, how much do you play in that space in regards to just general outlook for the real estate sector and I mean just home building in general and getting people in starting on that ladder, as I said.
Yeah, so it's true, right, that the Fed has greater influence over short-term interest rates and far less control or influence over long-term rates. And what's interesting is given the massive amounts of fiscal stimulus and what I would think of as very manipulative central bank policy through much of this century over the last 25 years, keeping monetary policy incredibly accommodative. Again, we're talking a lot of history. Not that long ago, we had $18 trillion in sovereign debt with negative interest rates.
Mm-hmm.
That exists in no CFA curriculum you and I ever saw. I had to pay the government of Germany to hold on to my money, right? It doesn't make any sense. So we're far removed from those scenarios. And so I think that you mentioned a few things. Structurally, the landscape is changing for investing. So we're reshaping the global trading system. The U.S. has asked its allies to share more equally in the burden of global security. That's had folks turn a little bit more inward and certainly has resulted in a global rally in defense stocks, and folks are kind of spending there. Others folks who are kind of go it alone. Germany spending more. Japan has a fiscal policy in place. So fiscal spending seems to be a bit more permanent to support economies' One Big Beautiful Bill Act. So supply of sovereign debt is increasing while the demand for it may be somewhat saturated. Saturated. Let's use that term.
Again.
And so we think that long-term rates may stay higher and more volatile than the market expects.
Mm-hmm.
And that does cause some interesting challenges. Now, I mentioned I don't expect a re-acceleration inflation, but inflation is just the kind of measuring the difference in price over a period of time.
Right.
So I'm not arguing. So for those listening who say, boy, that guy's crazy, Matthew, how could you even have him on? Hasn't he seen my insurance bill? Hasn't he seen my car payment? Hasn't he seen my rent or housing prices? I'm not saying prices aren't high, but they're not accelerating at the same rate.
Yes.
But costs are high. So inflation is likely to be a bit stickier. So in the decade prior to the pandemic, inflation in the U.S. averaged just 1.8%. It's more likely to average 2.5% to 3% over the next decade or so. So when we think about what you were talking about in terms of how do we think about this, at least from a portfolio perspective, when you think about stocks, and we talked a lot about that, over time, as long as the economy is growing and earnings are growing, your stocks are going to do just fine and they're a good inflation hedge. That's proven to be the case again. The challenge is in a recession, which we don't forecast in the short term.
And how far out do you forecast go? I mean,
anything past 12 months is, who knows? My crystal ball is as murky as everybody else's. So anyone tells you they got a 10-year forecast, you got to be careful.
Take it with a grain of salt.
Take it with a grain of salt. So, but if rates, particularly long rates, are going to be higher and more volatile, and inflation's going to be stickier, these are two kind of boogeymen for bonds, for fixed income instruments that pay a fixed rate of interest. Those are challenges. And so what we have been encouraging investors to think about to boost their resiliency in portfolios is investing a little bit more in real assets, real estate, infrastructure, commodities, natural resources, including precious metals like gold. And of course, we're coming off of 2 very solid years. So it fits in the heart of this notion of, permanent fiscal deficits, reshaping kind of the global macro landscape, the amount of sovereign debt that's going to have to be issued, the fact that many folks are looking to diversify away from dollars. It'll take forever. The U.S., we're going to be the world's reserve currency for as long as you and I are alive and in this industry.
Yeah, I never got that argument.
But folks are diversifying, seeking ways to diversify.
Yeah.
And some of these investments are ways to do that. They can generate income and total return. So we're encouraging folks to think about them more holistically in portfolio allocations.
I mean, do you consider those like alternatives? I know there's other alternatives like private equity and private credit. We're not going to go there. But I'm just curious if you consider commodities and real assets, would you categorize those as alternatives or not really?
I don't get too caught up in the definitions.
Yeah.
So in our outlook for 2026, we talked about this idea. One of the themes is to boost portfolio resiliency through the use of multi-asset strategies and alternatives. Yeah. But what we put forward in that was mostly things like commodities, natural resources, gold, and even some multi-asset strategies that use some components of that to really dampen some of the volatility, the stock market volatility.
And so is there a specific number? So if I say, all right, Mike, a 60-40 portfolio is your traditional moderate portfolio, do you guys go 60-35-5? Or are there, or do you not really make that call?
No, we do. And so I always joke that nobody uses 60-40 anymore, right? But it has actually, been a decent barometer, at least historically, particularly as rates have fallen and inflation's been benign. Mm-hmm. It's been the place to be. I would take that relative to many other choices, particularly at a low cost with transparency, liquidity, et cetera. But nobody does that 60-40. So we think about it as 60-30-10.
Okay.
From that standpoint, or you could get up to 15%, depending on risk tolerance and a number of other instances, but kind of 60-30-10, 60 stocks, 30 bonds, 10%, and a diversified portfolio of real assets we think makes some sense. That will replace some of your income, and should rates be higher and more volatile, particularly long-term rates, and inflation stickier, those real assets will do pretty well. In 2025, a diversified portfolio of real assets for most of the year actually outperformed the S&P 500 and the U.S. aggregate index, which is your kind of typical stock benchmark and your fixed income benchmark.
Right.
And so it was a good kind of choice to be making from that standpoint.
But it's interesting. So you mentioned real estate. Now, I'll leave residential real estate out of it for a moment, but relatively bullish on commercial real estate. I mean, it's been kind of in the doldrums, work from home, impact. I know that's the pendulum swinging back there pretty significantly. But I know, at least in Boston, I mean, I know it's a beautiful new building. I've not gone inside it, but I've walked by it on the way to the garden, of course. But point being is that there's still certain areas of the financial district, at least locally, that haven't rebounded since COVID. And from what I read, it's happening. We're not talking doom loop or nothing like that, but it seems to be a topic of conversation. So I didn't know if just general thoughts there on commercial real estate.
Right. I think residential real estate is somewhat more interesting in that, as you said, there is a shortage of residential real estate homes, and millennials are coming into their prime home buying age. That's actually creeped up. So they're now kind of in their early 30s, and that's in line with the primary home buying age, and there's a shortage of supply. So we think there's a supply-demand imbalance in residential that will keep that market and prices high, and those are pretty good. When it comes to commercial, what's interesting is that I think a lot of the bad news is behind us. So meaning that a lot of the buildings have been marked down in terms of their value. I think more people are going back to work in the buildings, and I think that as we get further away from the pandemic, businesses will continue to require more folks to come back.
Yeah, right.
And so I think that's happening. At the same time, when those valuations were written down and more people are coming back, folks took an opportunity to renegotiate those leases and at kind of longer
Market
term
rates.
and better rates.
Yeah.
So I think a lot of that's behind us, but this will take time to play out. Now, for those that are maybe a bit more on the nervous side, in context, commercial real estate, in terms of its size, about $4.5 trillion, about $1.6 trillion or so, that's kind of more finance that would come due in traditional sense. It's too small to cause a systemic problem from that standpoint, at least in our opinion. So it'll take a little while to work out, but most of the bad news is behind you. So here's what I think, Matthew, that's kind of interesting. And look, I'm here as a ETF investment strategist. I think being selective actively in commercial real estate has some real interest and value. Now, it's not my skill or what I do, but if I was an investor, I'd be considering picking up properties at much cheaper prices under better leasing conditions with lower kind of occupancy rates that could increase. There might be some attractive kind of opportunities there, particularly as we move further away from the pandemic.
Well, and I think, too, as you say, I kind of call it like pockets of value, right? I mean,
but selection's going to be key.
Yes.
Being active, being purposeful, being selective, right? So here, and this may seem strange to your audience, right? I don't think buying an exchange-traded fund across, hundreds of properties, you'll diversify some of the risk, but the real value add is going to be finding the right properties at the right value with some upside potential. And that requires a certain skill.
No, absolutely. And again, a manager selection, which is also key, and I don't want to say property selection. All right. So So in general, just to kind of summarize, because obviously, Mike, you've been very generous with your time, and we could keep you all day if we'd like, obviously. So I might have to. We'll turn the recording off and we'll just keep on going. But no, so in general, we have a very positive outlook for 2026 because of that. We're looking at easing. You're looking at the fact that we haven't really seen. I mean, obviously tariffs, there are pain there, but to a certain extent, as you mentioned, they may end up being more deflationary. In fact, according to certain recent studies, but in general, we're looking at a very benign outlook and no recessions. You mentioned there, so 2026 looks like it's going to be okay.
I've been describing myself as uncomfortably bullish. That is the title of our 2026 outlook.
Yeah.
So I'll do this quickly. So to your point, I think trade policy has stabilized. There's a lot of headline risk, but there's 17 frameworks in place. We're in a trade truce with China. Again, very tentative. And there's a million exemptions to these trades. It's impossible to make heads or tails of this thing. Overall, I think we've stabilized trade policy, which of course, back in April of 2025 was all
the exact opposite.
Was the exact opposite. So that's great. We have stimulus from the One Big Beautiful Bill Act. So Matthew, what's interesting is that in February to May of this year, of 2026, you'll get incrementally $150 billion in tax refunds. That money will get spent. Already, back in 2025, because of the ability to retroactively apply the immediate expense of research and development for domestic expenditures and the like, more than $100 billion has already been retroactively applied, and another $135 billion is coming. So that $100 billion in 2025 is already more than all of the tariff money collected to date. So that's very stimulative. Talked about the Fed at length, but we expect them to be easing. Earnings are growing. So they grew by double digits in 2025. They're expected to grow by double digits in 2026. Profit margins remain high. So despite all the anxiety about policy and tariffs, companies have been able to do more with less, and their profitability has rarely been higher. So they've been done an outstanding job. Then when we look at deregulation, I think is coming this year. I think that's where the Trump administration will pivot to now. And I also think that when you're looking at this, the U.S. is hosting in North America the World Cup, and we're celebrating the 250th anniversary of the signing of Declaration of Independence. And you're going to get a fair amount of momentum. Now, what makes me uncomfortable? Well, prices are really high. Valuations are stretched, positioning stretched. I'd prefer to be buying at cheaper valuations. Credit spreads are tight. Most measures of market volatility are complacent. So that's got my antenna up. And then we talked about the remaking of the global macro landscape. So the labor market being in that curious kind of balance, the remaking the global trading system, asking folks to share more equally in the burden of global security. These are things that are reshaping structurally the landscape that you and I and many of our listeners have become used to over the last kind of multi-decades.
Yeah, I was saying go back to Bretton Woods to a certain extent.
So we're not really sure what the impact is to the economy, rates, and inflation. And so that injects an element of potential volatility and discomfort on my uncomfortable. But overall, to use a pun, I think that the things I mentioned kind of more positively trump kind of the risks at this point.
Do you have a number of the S&P at end of the year?
I don't typically do that. You know what happens, Matthew? What happens is
you get nailed by
you look
it.
at, well, not that. You look at the dividend yield, you
Yeah.
look at the earnings, and you come up with some multiple, and every person like me tells you, 7, 8, 9%, right? And so I could tell you that. But what's interesting is when you look at a histogram, meaning if you look at how many, we go back to 1928, and we just count up the number of times the stock market is down 20, down 10, whatever buckets we want to use. It's rare that it's a single digit return. And that's when we look at that histogram, it's the single digits, 0 to 5, 0 to -5, 10%, down 10%. Those are the kind of the least amounts of hits. It's more in the tails, which goes back to my earlier point about kind of the tails happen far more frequently than the statistics would suggest. So again, my crystal ball is as murky as everyone else's. We're not sure what will happen next year, of course, but we think the foundation for this bull market remains in place. There are risks out there. So kind of boosting the resiliency of your portfolio is probably a good thing, always a good thing. And when I speak to folks like you, Matthew, and firms like SHP, I always believe that the value that many of you bring as it relates to investments, there's a tremendous amount of value outside of that. But when markets are at all-time highs and things are good and folks are feeling good, it's our role to remind them of the risks and the things that can go wrong.
Absolutely.
Conversely, when the market's falling out of bed and everyone's hair's on fire and they want to get out, it's our collective responsibility to remind them that if you have courage, capital, and conviction, it's often a good time to be buying stocks. One final thing that I'll mention is we were chatting a little bit around this notion. We were talking about time horizon. So back in April, we dusted off this chart. I'm sure you probably use it with clients as well. When you look at stock market returns, if you look at it on any given day, any given week, any given month, it's about 50-50 that you'll make money or lose money. But when you get to 5 years, you get to 10 years, when you get to 15 years especially, 15 years, you have a more than, at least based on history, if compliance is listening, a more than 90% chance of earning money over rolling 15-year periods, which is why you joked, hey, we're always bullish.
Yeah.
At least historically, the odds have been in our favor. Now, there's been lost decades, and I'm not sure if we'll be on one or not. But over time, if you're invested in the markets and in risk assets, and you have that long time horizon, the probabilities are in your favor. Doesn't mean you'll always make money, but the probabilities are in your favor. And we think the setup for this year also suggests that the probabilities are in your favor. We'll see what happens. Good luck to both of us.
Yeah, right. Exactly.
And everyone else listening.
Yeah, absolutely. Mike, thank you so much. I mean, I think it's a great note to end on. And I often talk about one of my favorite lines about what the markets do is that they climb the wall of worry. Right. We're all human. We all know whether you follow it every single day, like Mike and I do, or whether you just, pay attention every once in a while. There's always going to be concerns. There's always going to be issues. There's always going to be uncertainty. It's like, we don't know how the story ends. So since you don't know how the story ends, you're always going to be concerned about, I don't know how this is going to end. But you look towards history. You look towards the smart guys and smart men and women who are managing these companies here in America, managing monetary policy or at the Fed or wherever they are, and you just have to believe that these are all very smart individuals, and I think that is something you can trust in. Especially as I said, this is the 50th anniversary. I have been watching the Ken Burns thing. Also, highly recommend the American Revolution to anyone that is. We'll have a separate history podcast on that one. But yeah, it's just you have to believe in that, and you have to have faith, because I truly think that in time it will play itself out in your favor. So again, Mike, thank you so much. Again, it was an absolute pleasure to have you for the time that we had. Stay tuned next week, and everyone else be well. Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, and disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.